Welcome to the Macro-Micro Economic and Financial Commentary. I'm a host from the Macro-Micro Research team, and this is our weekly deep dive into the most significant developments shaping global markets and economic policy. Today is Monday, May 26th, 2025, and we're looking at a theme we've called Big and Bold, but Beautiful. It really gets at some key fiscal and monetary policy challenges right now.
That's right. We've got three big interconnected stories this week, all sort of testing that balance between, domestic policy goals and wider market stability. First, there's the U.S. House passing Trump's tax legislation. Very narrow margin. We need to unpack that. The debt ceiling angle, liquidity impacts.
Okay.
Second, Japan. Stress in the bond market there. 30-year yields hit a record, 3.18%. That has potential global ripples.
Definitely.
And finally, China. The PBOC just cut rates for the first time since October. So monetary easing in response to economic pressures, some linked to trade. Taken together, these stories really highlight just how tricky it is for policymakers right now. Domestic needs versus a very connected global financial system.
Let's start there in Washington, then. This one big, beautiful bill act. It's certainly ambitious. Passed the House, but only just, right? 215 to 214 on May 22nd. That sets up a really interesting, probably quite contentious Senate debate.
Absolutely. And the scale is huge. We're talking $3.8 trillion in proposed tax cuts over 10 years, plus a $4 trillion hike to the debt ceiling alongside it.
And the CBO, what's their take?
They estimate it would add $3.8 trillion to the deficit over that decade. So the cuts aren't projected to pay for themselves, basically.
Right. So what are the big pieces inside this bill?
Well, a key one is making the 2017 Tax Cuts and Jobs Act rates permanent. It also expands corporate deductions from 20% up to 23%. And there are new exemptions for income from tips and also overtime pay.
Interesting.
And then there's a SALT deduction cap, state and local tax. They want to increase that cap to $40,000.
And that was a sticking point, wasn't it? Explains the close vote, maybe?
Exactly. That narrow margin really showed the divisions within the Republican Party itself. You had disagreements over SALT, but also things like proposed Medicaid work requirements and just broader worries about, debt sustainability.
So how did the markets react to this squeaking through the House?
Well, we saw a noticeable jump in credit default swap spreads. The U.S. 5-year CDS, for instance. That's like the market pricing in a bit more risk. And some are calling it a triple downturn. Pressure across stocks, currencies, and bonds.
And Moody's recent downgrade probably didn't help confidence either.
No, that's certainly part of the backdrop.
Yeah.
It seems the market's stress isn't just the size of this package, but also the timing. It comes when a lot of Treasury debt is maturing, and we're already bumping up against the debt ceiling.
Right. And the Treasury's response shifting to shorter-term funding, is that right?
Yes, that seems to be the strategy, which ties into these complex debt ceiling dynamics. Remember, the Treasury's been using extraordinary measures since late January to avoid breaching the limit. And their cash balance, the Treasury General Account, or TGA, is currently around $590.4 billion.
Which is well below their target, isn't it?
It is. The target for quarter end is $850 billion.
Yeah.
So, significantly lower.
And that lower cash balance impacts liquidity.
It can, yes. Less cash held by Treasury means potentially less flowing through the system. And this situation is pushing them towards issuing more short-term Treasury bills.
Okay.
At the same time, you look at the Fed's balance sheet liabilities, the overnight reverse repo facility, the RRP, that's drained down to about $129.9 billion.
Still quite low.
Yes, while bank reserves are still pretty high, $3.219 trillion.
So this reliance on T-bills, it creates kind of a push-pull on liquidity.
You could put it that way, yeah. Dual pressures. On one side, the bills themselves are attractive for parking cash, pulling liquidity in. But on the other side, when the Treasury spends through its TGA, that pushes liquidity out into the system.
And looking ahead, July, August seems critical. The X day approaches.
Exactly. That's the time frame everyone's watching. If or when the debt ceiling is resolved, we could see a really significant absorption of liquidity. Think about it. Pressure from rolling over all those T-bills, the need to rebuild that TGA balance back towards its target.
And potentially funding this new deficit spending if the tax bill actually gets through the Senate and becomes law.
Precisely. A potential triple whammy for liquidity later this summer.
Okay, so this U.S. fiscal picture, the debt ceiling, liquidity, it really highlights the importance of global interest rates. Which brings us neatly to Japan. That 30-year JGB yield hitting 3.18%, that's a record. And and it feels significant.
It is significant, and it's not just a domestic story. This has potential knock-on effects globally. We've seen this gradual climb in long-term JGB yields since the pandemic, really. It reflects the Bank of Japan slowly, carefully, moving away from ultra-easy policy, ending yield curve control.
Which kept rates capped for so long.
Exactly. And starting small rate hikes, beginning quantitative tightening, shrinking their balance sheet.
And presumably, changing inflation and wage dynamics in Japan are pushing them further down this normalization path?
That seems to be the driver, yes. Market expectations are shifting. The BOJ's own bond market survey, the latest one, showed the market functioning index plunged to -44 in Q2.
-44, wow.
Yeah, that's the lowest it's been since May 2023. So dealers are finding it much harder to trade smoothly.
And auction results, too.
Yes, the 20-year bond auction on May 20th was quite poor. The bid-to-cover ratio fell to 2.50. That's the weakest demand since 2012.
Okay.
And the tail of the gap between the average and highest accepted yield widened out to 1.14 yen. That's the widest since way back in 1987. Indicates real uncertainty among bidders.
So clear signs of market stress. But what about Japan's underlying fiscal health? Is that a major concern driving this, or is it more about monetary policy shifts?
That's a really important distinction. Actually, Japan's fiscal position has improved quite a bit. Their main taxes, income, corporate, consumption make up about 90% of revenue, and they're all growing, thanks to wages picking up, decent corporate profits, a bit of inflation.
Okay.
So the deficit has actually narrowed quite significantly since 2020, down to around -2% of nominal GDP. That's actually one of the better positions among developed economies right now.
That's surprising to some, I think.
It might be. Plus, they still have a negative rate growth differential. Growth is higher than their average borrowing cost. The IMF actually expects their debt-to-GDP ratio to remain pretty stable.
Okay, so the fiscal side looks relatively okay, maybe even improving. But the risks come from the global connections.
Precisely. Interconnectedness is key here. Japanese banks have massively increased their yen lending abroad. It's up to around $1 trillion, or 145 trillion yen.
Huge number.
It is, and that creates potential reversal risk if asset managers start shifting positions globally as Japanese rates rise. And of course, Japan is the largest foreign holder of U.S. debt.
Right, so if JGBs become more attractive domestically,
the Japanese institutions, like the big life insurers, might decide to sell some of their U.S. treasuries and buy more JGBs instead. That could put upward pressure on U.S. yields too.
So, lots of moving parts. What are the key dates or events we should watch for in the second half of this year?
Okay, a few things. In June, we expect the BOJ to lay out its detailed plan for shrinking its balance sheet over the next year or so. Markets are thinking maybe a gradual 6-7% reduction over 2 years.
Okay, gradual.
Then in July, that 90-day pause on certain U.S.-China tariffs expires. Will they resume? That's a big question for global trade. Third quarter, as we discussed, could see potential passage of that U.S. tax and debt ceiling package. If so, expect more long-duration Treasury supply hitting the market. And finally, just the ongoing central bank divergence. Markets are pricing, 2 Fed cuts and 1 BOJ hike in the second half?
That's the current thinking, yes.
Right. But, surprises are always possible there. Policy paths could easily change.
Okay, let's shift now to the third major story. China. Monetary easing there. They cut loan prime rates.
Yes, for the first time since October last year. On May 20th, the People's Bank of China, the PBOC, cut the 1-year LPR by 10 basis points down to 3.0%. And the 5-year LPR, which is more relevant for mortgages, was also reduced down to 3.5%.
And the timing is interesting, coming not long after those reports of U.S. tariffs being reduced somewhat after negotiations.
Exactly. Those tariffs were reportedly cut from 145% down to 30% in mid-May. You can see why China might feel the need to stimulate. April's economic data really showed the bite from those trade tensions, especially on manufacturing.
How so?
Industrial value-added growth slowed sharply from 7.7% down to 6.1%, and export delivery value growth just collapsed. It went from 7.7% growth previously to just 0.9%.
Wow, flatlining.
Pretty much, you saw it in specific export sectors. Mobile phones down, computers down, textiles negative growth.
And that mirrors what we saw in U.S. export data for April too, right? That big drop.
Yes. U.S. export growth fell off a cliff, minus 21% in April. It shows how these tariffs hit both sides. Though it's worth noting, some parts of China's industry are still doing very well. Autos, industrial robots up over 50%. Solar equipment, power generation gear, machine tools, integrated circuits, those areas show resilience.
But what about the domestic side, consumption?
That was a bit weaker than expected. Social retail sales grew 5.1% year-on-year, down from 5.9%. And this is despite some government efforts to boost spending. It suggests maybe a confidence issue among consumers.
And the property sector? Still struggling.
Still under pressure, yes. National housing prices down 4.0% year-on-year. Commercial housing sales value Jan to April was down 2.8% from last year. The sentiment index there is still very subdued, around 93.86.
So that 5-year LPR cut is aimed squarely at housing, trying to reduce mortgage costs.
That's the main target, yes. Trying to make mortgages cheaper. On a typical 1 million yuan 30-year mortgage, that cut might save the borrower around 20,000 yuan over the loan's life. Not huge, but intended to help sentiment.
But the tariff uncertainty must hang over everything, impacting confidence and spending, too.
It certainly compounds the domestic challenges, absolutely. It weighs on business decisions and consumer sentiment.
How effective can these rate cuts be, though? Aren't bank margins already really tight in China?
They are. Commercial banks' net interest margins are at a record low, just 1.43%. That definitely limits how much appetite or capacity they have to significantly boost lending, even with lower policy rates.
So the policy response maybe stabilizes things near term, but doesn't solve deeper issues.
That seems to be the assessment. It's geared towards stabilization, maybe helped by that potential export pickup if the tariff situation improves post-negotiations. Lower LPRs, plus some earlier deposit rate cuts by big banks, are meant to encourage credit.
But are we seeing signs it's working, or signs it might not be enough?
Well, some signs suggest it might be insufficient so far. April's new bank loan numbers were below expectations. And private investment growth is basically 0.2%. That's a real worry.
Even while manufacturing investment is strong.
Right. Manufacturing investment grew 8.8%. The contrast suggests private firms outside of state-supported sectors are very cautious. Targeted support for EVs, renewables, advanced manufacturing that's working well in those specific areas. But it's not clear if that can lift the whole economy enough.
So analysts are becoming more skeptical about hitting that 5% growth target this year without bigger stimulus.
Yes, doubts are definitely growing. Achieving around 5% might require more forceful action, potentially on the fiscal side as well. Yeah. And of course, China's slowdown, or even just sluggish growth, has big implications globally for commodity prices, supply chains, emerging markets that depend on Chinese demand.
Okay, a complex picture across the board. Let's quickly look ahead at the economic calendar for the rest of this week. What should we be watching?
Right, a few key things. Wednesday, May 28th, we get NVIDIA's Q1 earnings. Hugely important given their role in AI. Revenue expected around $43.4 billion. That's up, 66.5% year-on-year. EPS forecast $0.83.
And the focus there will be tariffs, GB200 shipments.
Exactly. Tariff impacts on data centers, GB200 ramp up, orders from the Middle East, any updates on H20 sales restrictions to China, lots to unpack there.
Then Friday brings key U.S. inflation data.
Yes, April PCE. Headline forecast is 2.23% year-on-year, down slightly from 2.29%. Core PCE expected at 2.6%, also down a touch from 2.65%. Very important for the Fed's thinking and for the U.S. dollar.
Also on Friday, India GDP.
That's right, India's Q1 2025 GDP. Growth expected to pick up to 6.8% year-on-year from 6.2% previously, seems supported by strong vehicle sales, services, manufacturing PMIs.
And finally, China PMI.
Yes, China's official May manufacturing PMI also out Friday. Expectations around 49.5, still just below that 50 line, separating contraction from expansion. A move back above 50 would be a positive signal for exports.
Okay, thanks. So pulling all these threads together, the U.S. fiscal debates, Japan's bond market unease, China's easing, what's the main takeaway?
I think the main takeaway is that we're really at a point where fiscal ambitions, the tricky path of monetary policy normalization, and just basic economic resilience are all being tested simultaneously. You see the U.S. grappling with fiscal choices, debt sustainability, and the resulting liquidity pressures from how they finance it all. You see Japan's bond market showing real strain as the BOJ normalizes, with potential spillover effects for global carry trades and the U.S. Treasury market.
Right.
And in China, you see monetary policy trying to support growth, but possibly hitting limitations in addressing deeper structural issues and confidence deficits.
So less room for error, less tolerance for policy surprises, maybe.
I think that's fair to say. Market liquidity, policy credibility, and frankly, international cooperation seem more important than ever in this environment. Things feel a bit more fragile.
A critical juncture indeed. Well, thank you for breaking that all down for us, and thank you for joining us for this week's macro-microeconomic and financial commentary. We will, of course, keep tracking these developments and the key events on the horizon. Until next week, this is your macro-micro research team, helping you navigate the complex currents of global markets and economic policy.
Want more insights like these? Join our MM Max subscription and get full access to our expert reports and in-depth market analysis.